اللقاء الماضي كنا نحكي بالانكم ستيتمنت والكومبوننتس اوف ذا انكم ستيتمنت. خلينا بس انه انا اذكركم just remind you in the main account in the income statement. بس مع بعض نتذكر الحسابات الرئيسيه بالانكم ستيتمنت. احنا كنا نبدا بالسيلز. Okay, we start sales. Then we deduct the cost of goods sold. بيطلع عندنا الجروس profits. Then we deduct the operating expenses. So we have operating income. So we deduct the interest I. So we get the pre-tax income or EBT, earning before tax,
yes.
Which is this the same. Then we deduct the tax.
Yes.
We end with net income. Okay? So this is the story of preparing the income statement. Now, for the income statement, for the net income, how we manage the net income. So net income here, generally we have two main policies to think on the income statement or in the income profits. The first one is to pay them out as a dividends, or to invest in the long-term investment as return earnings. Okay, so we have two different policies, and these two policies influence on the firm value. Okay, so let's consider this case. If we look at when we evaluate any stock R, this is the return of a particular stock R, the return of a particular stock, which is equal the dividends yield plus the capital gains. So the capital gains is coming from the investment, which is here the capital gain. From mathematical point of view, again, this is R. Dividends is the dividend yield, D divided by B naught. D is the dividends. B naught is the price at the buying price plus B1 minus B naught divided by B naught. Look at these two policies. The first one, dividends, influence on this part. The return earnings influence on this part. So some investors are looking for the dividend yield, other investors looking at the capital gains. Okay? So this is why the companies be careful in determining how much to pay out and how much to retain profits, because it influences on the dividend yield, this part, dividend yields, and influence on the capital gains. For instance, if we decided to pay 0 dividends and keep all of our profits, so we will maximize this. But in the opposite, if we decided to keep no profits, then we maximize this. Some managers may mix between the two main policies by giving portion of dividends and portion of retained profits, so they maximize both. Let's see what is the difference between dividends and what is the difference between retained earnings. What are the investors who are looking for dividends and investors are looking for capital gains? Let's see about very little example here. If we have old man and retired, and his age in 60 years. He's in his 60 years old. This man prefer dividends or retained earnings? Dividends. So this investor is focused on the dividends. Let's take another example. A woman with 50 years old, focus on this, dividends or in retained earnings? Still in dividends. Okay, let's take another example. A businessman with 40 years old, where he focus? In retained earnings. He prefer the capital gains. Okay? The main difference, the lady with 50 years old and the man with 60 years old, he needs cash. He needs dividends to secure his life or her life. So some investors are looking for dividends because depends on their situation, and other investors are looking for the capital gains, again depends on their situation. So the companies, again, they want to achieve or fulfill the investors' perspectives. We have different perspectives, we have different needs, so we have to address all of these needs according to the understanding of how we distribute the net income between the dividends and retained earnings. Okay, let's go back to the connections between net income account and the balance sheet account. The retained earnings here, if you look at the retained earnings is putting in the balance sheet. So we understand the difference between the dividends yield and the capital gains. Is it clear now? Okay. Let's see the connection between the income statement and the balance sheet. خلينا نشوف income statement and the balance sheets. Let's go back again. This is the net income. We say this is dividends and this is retained earnings. If you look at the balance sheet statement, so this is the balance sheet statement. Here is the asset and here is the liabilities. And as we said before, this is the quarters, this is current asset, and here current liabilities, fixed asset, long-term liabilities, and equity. Fine? So retained earnings, now the connection between the net income and the balance sheet, retained earnings is included in the balance sheet. Okay? So we consider it as a particular part, as an important part in the equity. Okay. So the retained earnings here, in this place, giving opportunity to the business to finance this part. So retained earnings is coming from the net income as an equity. Then if we have opportunities for long-term investment, because here is the opportunities of the investments, we have fund or sufficient funds to finance from this part, from the retained earnings. So what I want to say in this part, retained earnings is an important part in finance because it gives a cheap opportunity or very cheap source of funds comparing with other financial sources. If we compare between the retained earnings and shares or with debts or loans, we will see that the retained earnings is cheaper than any other activities. This is why companies prefer to keep the profits rather to pay them out. So this is the connection between the balance sheets and the income statement. Any question? As explained here, what can the firm do with the net income I explained in this. Pay dividends, reinvest in the firms. And if you look this example here, review the example in 1 and 2. If we go back to example 1 and 2, just go back to example 1. Just remember, in firm reports, a net income 90 million. So we have 90 million here as net income. And has 35 million shares outstanding. What will be the, okay. So this is example 1. Example 2, a firm reward dividends payment of 20 million. So the dividends here is 20 million. So what is the retained earnings? It will be 70 million. So let's go back to the example 3. So the amount retained is equal net income minus dividends. Net income 90 minus 20, so we have 70. 70 million as retained earnings. Okay. What we can learn from the Boswell incorporations. Let's go back and to scrutinize the income statement of Boswell. Let's go back and to see. Look at this statement. What we understand from this statement. First of all, when you are looking at the income statement, you have to focus on the 4 main accounts. I mean from financial perspective, not from the accounting perspective. I'm not looking at how they arrange, how they locate, how they calculate these statements. I'm looking for 4 main figures. This is the first one, the gross profits. Then I will look at the net income, which is this one. And I will look at the earning before tax, this one. And I will look at the net income, this one. These are the first, or the main, the most important account in the income statement. Now, what is the importance of these accounts? To know the importance of these accounts, we have to, or we should compare these accounts with the sales. For instance, this one, gross profit, compare with the sales to see how the sales contribute in these accounts. Why the sales? Why sales is important? Yeah, this is a question to you. Why sales is important? Because it generates a profit. This is the first one. Okay, what else? Because it generates profits. Okay?
Because it's the main
yes.
source of funds.
Yes, because it is the main source of funds. And because it is the main, it represents the majority of the source of funds in the business. Okay, this is fine. What else? Yes, because sales is directly related with the customers. And sales is sensitive in terms of measuring to what extent that customers are satisfied with the business. If sales is high, this indicates that the business is acceptable to the customers. If the sales is getting low, it means it indicates that the business may challenge problems. So the sales is giving the symptoms in the business or early indicators to the business. If the sales is fine, the business is fine. If the sales is not fine, so we have to check the strategy or the tactical things in the business. So this is why the business is important. Now, we are looking at the gross profits. We compare these items with the sales to see the efficiency and the effectiveness of the sales. For instance, if we talk about the gross profits here and just divided 675 by 2,700, it gives 25%. If you divided this on this, what it means is 25%. It means that $1 is invested in sales generated 25 cents as gross profits. So 25% means here, 25% means $1 in sales generates or produce 25 cents. 25 cents. Okay. We expect that this figure or this percentage to be high to consume the other expenses. Because when you go down, this rate diminish, gradually diminish. It may reach to around 8% or 6%. So if this rate is high, so the other expenses eating less from the main account. Just try to figure out what I'm saying here. If, for instance, if this is just only 15%, we don't have room, you know room? We don't have room, we don't have, not room, this room. We don't have a space. Yes. So we don't have room to consume the expenses. So in order to have space or to have a room to generate or to cover our expenses, this rate should be high. And just think of it. If you generate here 40%, let's see, 40%, it means you have more room to have more expenses, to cover expenses, and you have the rest. But if you have a very narrow space or very narrow room, if we have 10%, so we may challenge problems. So this is the idea of understanding the first part of the income statement, which is the most important one, because it holds the higher expenses, comparing with other expenses. Let's go back to the example. So the marketing department should be working hard in order to generate more sales and to minimize the cost of sales at the minimum level in order to maximize the gross profits. Okay? Okay. And let's see. Go back to the So interpreting the profitability, you look at these four main accounts. These profit margins, gross profit margin, okay, they should be closely monitored and compared to the previous years and those of competing firms. And the GAAP and earnings management, while the firms must adhere to set accounting principles, there's a considerable room for manager to influence the firm's reported earnings. Managers have an incentive to tamper with reported earnings, and their pay depends upon it, and investors care about it. It means the managers, they carefully looking at the importance of income statement, because it has direct relation to the retained earnings and for long-term investments, as well as on the maximizing the value of the firm. Let's go back to the interpreting profitability. Yes, in here, the gross profit margin, as I explained, the gross profit divided by sales, so we have 25%. I explained this, $1 generates 25 cents. And the markup is 75%. The markup is mukammal. So the 75%, it means $1 invested in this business cost 75 cents as a cost, a sales of goods, a sales of cost goods. And the operating profit is the sales divided by the operating profit divided by the sales. So 382 million divided by 2,000, so this is 14%. If you compare 14% with the 25%, so 25% ate around 10%. So 10% is the operating expenses. So the difference between 14% with the 25% is around 10%. So this 10% represents the operating expenses. And if you compare this 10% with the 25%, it's considered as a half of it. So this is 10%. Comparing with the 25%. 10% is the difference between this one and the 25%. So this is why it's important to generate more sales or more net profit margin in order to be relaxed in the business. The net profit margin is the net profit or net income divided by sales. And we see 7.5%. Let's put all of them together here and just to compare between them. So the gross profit margin is 25%. Okay? The operating profit margin is 14.17%. Okay? The net profit margin is 7.58%. So what you observe in these figures? The first one is 25%. The second is 14.17%. And the third is 7.58%. Sorry? So what you observe? Gross profit margin 25%, operating profit margin is 14%, then net profit is 7.58% or 58%. What you observe in this case? Yes, diminish. Yes. Why this? Because of expenses. Because of the expenses. Yes. So if you look at 7.15, it's like half of 14%. And this is the difference between this around 10%. So here, operating expenses consider around 10% of the expenses. And the interest and taxes is considered about 8% of the business. So interest and taxes eat around 8% of our income, which bits high. Or if we talk about this part, operational profits, it ate around 10% from our income. So this is important. This is a stable company. I mean, it's fine to this business. But the problem in companies, if we have a problem like this, if we have here 10%, so we don't have room, 3%, then we end with minus 7%. In order to secure ourselves in this area, we have to maximize this area in order to be in a safe place. Try to do this. Checkpoint 3.1. This is about GAP, products under the GAP. You know GAP. Company GAP. Use the following information to construct an income statement. Okay? For GAP. You don't know GAP? GAP. What this for? GAP. What this for? Sport? No. No, this company. Gap, yes. Yeah, dresses. Yeah, Gap. It's a well-known brand name. Okay? Gap. Okay, so Gap, Old Navy, Banana Republic, Pepper Lime, and Athleta brand names use the scrambled information, مبعترة مخربطة يعني حسابات مخربطة. Scrambled information below to calculate the firm's gross profits. بدنا gross profits, operating income, and net income for the year ended January 31st of 2009. Then calculate the firm's earning per share and dividends per share. بدنا نحسب dividends per share. هاي هم accounts الموجودين عندنا. طبعا follow the rules that I explained before. Gross profits, then operating net income, then the pre-tax profit, then the net income. Okay, this is the rules. And see the decide on a solution strategy. This is how you can answer the question and check yourself. Gap's income statement use this information statement assuming the firm is able to cut its cost of goods sold by 10%. And where the firm pays tax at 40% rate, what is the firm's net income and earning per share? Use this information, then you will have the corporate taxes. You know the corporations have to pay tax. Tax is important to managers. And because higher tax rates, it means marginalize the income generated by managers. So tax has direct impact on the business activities. But we have to pay tax because the governments have to fund their activities and protect the business. Corporate taxes. A firm income tax liability is calculated using its taxable income and the tax rate on corporate income. What it means taxable income? What it means taxable income? Sorry? Yes. Okay, what else? Taxable income. After tax? After tax or before tax? Before tax. Before tax.
Earning before tax.
Earning before tax. Yes. Or pre-tax. Or EBT. Earning before tax. Okay? So you are right. Taxable income is the income subject to tax. This is fine. What is the income that's subject to tax? As we explained, this is gross profits. We don't need this. We have the gross profits. Then we have operating profits. We have then the pre-tax. This is the taxable income, pre-tax, or we can use the term of earning before tax. Is this taxable at a particular tax rate? This tax rate is differ from business to business. For instance, smaller companies paying lower rates, however, the larger companies paying higher rates. Okay? Now, so we know the tax rates. We have a term tax rates, and we have term of marginalized tax or tax margin. Let's see the main difference between these tax. Look at this table here. Corporate tax rates. Taxable income. In here, business generate from 0 to $50,000 pay 15%. A business generates more than 50,000 up to 75,000 pay 25%, and so on. So if we have $60,000, what is the marginal tax? 25%. Do some calculations. How much we should pay to the government? Just $60,000. How much? It means 60,000 times 25%. This is what you mean? Okay. 10,000. 10,000. Okay, so 10,000 here. What is the rest? What is the rest? 50, yes. 50,000 percent times 15%. Okay, so you sum this with this. This is the tax to the government. Is this right? Yes, we do them. Okay, this is right. So we look at the 50,000. We pay 50,000 first, and time by 15%. We have this tax. Then the rest is 10,000 times by 25%. We have this rate. Then we sum this part with this part. We have the tax payment. Okay, so this is sorry. 10,000 هلا بناخذ 50,000 لها ماشي 60 عندنا 60,000 في الانكم اول وحده قديش حتاخذ منها 50,000 نضربها في 15% خلصنا بزيد كم 10,000 نضربها في 25% ذاتس ات خلينا ناخذ مثال اخر لو كان عندي 100,000 the taxable income is 100,000. Irene, if we have 100,000, what is the tax? What we can do then? Yes. Yes. The first one. 50,000 times 15%. Okay. Then 25,000 times 25%. Then 25,000 times 34%. And you sum this. Okay. So this is the taxes. Yes. اوكي خلينا نعيدها كمان مره. احنا اذا معاكي انت 50,000 اذا ربحتي 50,000 بدك تدفعي 15% عليهم. اذا ربحتي من 50,000 ل 75,000 يعني قديش احنا ضفنا هان 25,000 تمام حنربح 25%. طيب ال 25,000 الثالثه حنربحها حندفع عليها 34%. خلينا ستيب باي ستيب. اول 50,000 دفعنا عليهم 15%. هي ربحنا احنا 100,000 خلصنا. نيجي هذه قديش ندفع على 25,000 الثانيه حندفع عليها 25%. هاي ال 25,000 الثانيه ضربناها ب 25%. طيب في 25,000 اللي بعديها 34%. اوكي سو 35 وبنجمع هذا التاكس اللي حندفعه لمين للجفرمنت. This tax to be paid to the government. في هذا الرينج حنيجي حتكون 34%. هدول حندفعهم من الحكومة مش ضريبة على الجزء هذا ضريبة على الجزء هذا ضريبة على الجزء هذا. ما احنا دفعنا ضريبة على الجزء كله احنا دافعين بس الجزء بنفعش نروح ندفع ضريبة للشركات الصغيرة تدفع نفس الضريبة للشركات الكبيرة. يعني الشركات الصغيرة تدفع نفس ضريبة الشركات الصغيرة. فإيش بنسوي؟ كل ما إحنا بزيد الإنكم كل ما الضريبة حتزيد. لو على كلامك بدنا نمشي إيش بنسوي؟ لو أنا 100,000 حطبقها على 15% كل الشركات تدفع نفس الريت. فكل ما بزيد الإنكم تبعي كل ما أنا برفع معدل الضريبة. هاي 100,000 يعني قصدك نطبقها هان؟ لا مش هيك بتصير، لأنه هذه الضريبة مدفوعة بس على 25,000 هان. إيش معنى الضريبة؟ إيش معنى marginal tax is the additional $1 to be taxed. يعني إذا إحنا ربحنا $1 زيادة قديش حناخد عليه ضريبة؟ مش as a sum ال100,000 ناخدها زي ما هي ونضربها في الرقم، يعني نيجي نضربها هان. طب إحنا إجينا ال100,000 على كلامك وقعت هان صح؟ This is unfair.
لانه حيطلع عليها التاكس،
حيطلع عليها 100,000 34% كثير. فايش بنسوي؟ اوكي كم هذا نصيبها؟ 50,000. اوكي كم هذا نصيبها؟ 25,000. اوكي ها 75 قديش ضل؟ 25,000. كل واحدة بنضربها في اللي قبالها. هذا بسموه المارجنال تاكس ريت. Okay, so corporate tax rates, the table reveals that the following. Tax rate range from 15% to 39%. يعني 15% 39% من أعلى شيء لأقل شيء. بتلاحظوا the tax rate is increased till here. This is the peak, then it's go down. Then, okay, yes. Tax rates are progressive. Larger corporations with higher profits will tend to pay more taxes compared with the smaller firms. Note, in addition to federal tax, a firm may face state and city taxes. يعني كمان بدفعوا ضريبة city taxes وال marginal and average tax rates. While analyzing the tax consequences of a new business venture, the appropriate tax rate is the marginal tax rate. اللي هو المارجنال إنه حسب قديش إحنا بناخد income، مش مرة واحدة نضرب الضريبة. Marginal tax rate is the tax rate that company will pay on its next dollar, as I explained, on its next dollar of the taxable income, to the next dollar, not as a lump sum. Average tax rate is the total taxes paid divided by the taxable income. Average tax rate. بعدين بدنا نعرف قديش الافريج tax rate. ايش بنسوي؟ بنطلع التوتال هذا وبنقسمه على 100,000 بيطلع الافريج تاكس ريت. تتوقعوا قديش بكون الافريج تاكس ريت في الحالة هذه؟ يعني توقعوا لي قديش؟ تقريبا 22%. لكن لو احنا ضربناه ب 34% حندفع 34%. فاحنا هذا is fair. يعني الافريج تاكس ريت is fair in this case. Okay, and this is the explanation of the tax rate. Taxable income 50,000. لو احنا رجعنا ل this, which is similar to this, 50,000 75. نرجع لهدول. هاي 50,000 طلعوا هذا accumulative 50,000 دفعناهم. بعدين حنضيف ال 25,000 حيصير كم؟ حنضيف ال 25,000 حيصير 100,000. اوكي 15% 25% 34%. قيمة التاكس 7,500 في ال 50,000 6,250 في ال 25% في ال 25,000 8,500 في ال 34% 25 بيطلع هذه الأرقام ودبل تشيك. try to double check this. Average tax rates as we say here, the total tax اللي حندفعه 22,250. okay, 2,250 divided by $100,000, so the average tax is 22.25%. okay, and a marginal tax rate 39%, as the firm will have to pay 39% on its next dollar. So now for the next dollar, if you go back in here, if the business make 100,000 plus $1. The business will pay 39%. So the next dollar. And average tax rate is, as we explained, on its next dollar of the taxable income. If it is taxable income, increases from $100,000 to 100,000 plus $1. So it takes the next dollar or the next margin. Okay, let's stop in here, and we will talk about the dividends and the taxable dividends. Okay. Next meeting, please just read the previous chapters. And inshallah, we'll talk about the dividends and talk about the balance sheets. And do the checkpoints. Do the checkpoints. التشيك 3.1 تحاولوا تشتغلوها، وإذا أنتم في عندكم مشكلة بس بتراجعونا فيها. أوكي، الله يعطيكم العافية.